if it looks like the big boys are going to win again, and to me, the big push when silver hit $30 back at the end of last month, when that failed, this changed from the Wall Street bets crowd being in control. They only had 13% to go. If they had been able to clean that out, something would have broken. We would have had $50 silver. Hi, this is Mike Maloney with Jeff Clark once again. Jeff, how are you doing?
I'm doing great today, Mike, and it's great to be back with you, of course. And today, ladies and gentlemen, we have something a little different for you, something special. We're calling it a chart special. It's a bunch of charts that Mike has put together himself. So we're not going to do the usual article of the day and tweet of the day and things like that. This is going to be some charts that Mike wants to get across to everyone. So this should be really good. So Mike, you've got them set up here. So tell us about this first chart.
Okay, actually, this was made, if you see up in the left-hand corner, October 30th, 2020. And I just drew a chart. Every once in a while, I do this out of curiosity. Now, one of the things that I do want to tell everybody here, I am not a technical analyst. So you can't take any of this as investment advice or, I do this once in a while, playing around for my own education, input, entertainment, and so on. And so I'll go on to stock charts and create these charts where you can do things like put in Fibonacci sequences, which is the red lines on this chart. I drew a support range from a support area from a trading range that happened back in April, May, June, July. And then there's a 200-day moving average. What I saw in this chart when I put it together, and the first time I actually put this together was 1 month earlier than this. It was September 30th, roughly, after gold had made a dip. So this first chart is gold, and it's a one-year chart. When I drew all of these things, I saw what I call a triple magnet. And whenever I see like a triple or quadruple magnet, 2-3 things landing on the same price range. We had the 200-day moving average, which almost everything, whether it's a stock, an indice, a particular commodity like gold, almost everything has to revisit its 200-day moving average sometime or another. And what you see here is back in the March crash, gold went through its 200-day moving average, pierced it, and then bounced back up, and then entered this trading range, and then zoomed up to almost $2,100. And you draw a Fibonacci sequence over the top of it. That's the red horizontal lines. And Fibonacci, this is something that happens in nature all the time. You've got the move from the March bottoms to the August peak, and then a 38.2% retracement, a 50% retracement, and a 61.8% retracement. And you see this in herding patterns. And humans do these herding patterns, especially when you've got so many of them interacting like they do in the markets. And so when I saw the 50% retracement and the support for the trading range and the 200-day moving average all converging on that 1771 area, I decided that gold could be attracted back to this area. It might fall to that 1770, 1780 price range area. And so I took a look at silver, and silver has a major trading range that happened November, December of 2019, January, February, March of 2020. And then you had the crash, and I drew some fibs there. Now, the 200-day wasn't even on this chart yet because silver makes such dramatic moves. But I did see this double magnet of the 61.8% retracement and the major trading range. So I decided to see if I could set targets, and if either one of them dropped these levels, I would make a buy. And then the next chart is gold updated on November 27th of 2020. you see that what I did here was I added some more moving averages. There's a 200, a 220, and a 250 day. The reason I added these is I played around with it and I looked at those March lows, and I wanted to know how far below the March lows the close of the day was, and the intraday trading. And when you measure with the close, it comes out at the 220-day moving average was the bottom in March. And when you measure the intraday, that green line encapsulates the intraday price action at the 250-day. And so I was watching this, and I generated this on the day that I made a purchase that day. All of my insiders found out about it. I posted it just a day or two later. I made a purchase of gold, not silver. I was really hoping that gold, when it pierced that 38.2% retracement and the previous support that it had from bouncing off of that, I was hoping it would drag silver through its support, and it didn't. So tell me what you see in these, Jeff. Do you see anything that I don't see? And
this is actually very reassuring to look at, because every once in a while someone will ask, are you sure we're really in a bull market? And this shows, the green line shows the 250-day moving average that we are, in fact, still in a bull market.
Yes.
And this actually can give you confidence about when to buy. You look at these major support levels and when they can be hit. And those are very good entry points. So I like it.
Yeah. So I made a purchase of gold on that day within about $2 of the very bottom. And anyway, let's move on. The next chart here is the entire bull market of gold from 2001 until today. And you see this, this almost it's interesting riding through this thing. You see that you can draw a trend line on it from 2002 until about 2005, and then there's a little bowl that pierces through in 2004 actually, and 2005, 2006. That trend line is violated. Gold went sideways for a little while, and everybody was going, "Oh, the bull market is over with." And I was writing an article called "The Great Fake Out Shakeout" because all these people were selling out their positions and stuff, and it just and I said it was going to continue, and it did. It continued on up big time. There's that big move in late 2005 into 2006. And then we went through that bear market in 2007 and early 2008. Everybody's saying, "Oh, it's over with," and this is part of this. The major portion of this dip that happened in 2008 is all of the liquidation that was happening during the market crash of 2008, the global financial crisis, because a lot of people have gold futures, and they've got gold on margin, and they've got gold contracts on the same trading platform. They've got GLD and SLV on their trading platforms that they have that they have all of their other stocks, and the stock market was crashing. And gold bottomed in October of 2008. The markets kept on crashing until March of 2009. But everybody was saying that gold bull market is over with. And then we have the 2011 peak up at $1,900. And we've got this cyclical bear inside of what I call it's a secular bull market in gold. I really consider this one huge bull market. I don't consider this mid-cycle correction is what I call this thing from 2011 until today. This is nothing but a mid-cycle correction for somebody that has patience and has really looked at monetary history. And so I've just been adding to my positions during this pullback from 2013 through today. I've continued adding to my position. And, and I started buying in October of 2002 with gold at a $315 spot price. I was buying gold eagles for about $325, I believe. There's a video on it. But in the next chart, what you see is there's a bowl pattern that has formed. This is a Fibonacci arc. And
we
you
should
can
point
draw
out,
this.
Mike, sorry to interrupt you. We should point out this is a log chart too.
Oh, yes. Yeah, it is a log chart. So what you're looking at is the percentage difference in gains, not the price difference in gains. So anyway, what you see here, though, there's a little bit of room for a further pullback. Now, if gold violates this bull significantly, then we're probably doing something that's called making a cup and handle. But that would require the economy and the markets to stay in a good condition for a fairly long period of time, maybe another 2 or 3 years. It's possible. I just don't see that happening. And then it could make this cup and then a handle on the cup. So we've got the cup. But a lot of times, just like in the 2009 crisis, you have a very symmetrical pattern. We might just have one more year, like there was a reflection from 2011, 2012 timeframe. We could be making that, and in that case, we're like already halfway through it. And then the bull market continues, or it might start, when it tags this bull. We're in this period of indecision. I'm just playing around with technical analysis here. The indecision is that it could go up, or, when I first became a precious metals dealer, one of my major suppliers, I would call to place an order, and I'd say, well, do you think gold is, where do you think gold is headed? And they'd go, it's headed up, or it's headed down. What's the order you want to place? They don't care about what direction. They're just making a tiny little spread when they buy or sell, because they're fully hedged. And so they only care that you place an order. That's all they care about. But we're at this point where it could go up or it could go down. It's not going to go down a lot if it does. A lot of people hate this when I say it, but I'm in a position where I've accumulated enough. And so if it goes up from here, that's okay. If it goes down, I'm going to use that as a buying opportunity and add to my position. But boy, for many, many years, I was in the same position that a lot of people are in right now, where I'm going, I'm worried about the economy. I know that this is the right thing to do. Should I buy now or should I wait for a pullback? And, if you don't have any, you might want to just go ahead and buy and then suffer through any pullback that happens. That's what I did. And I'm not making any recommendations. But if you've already got a large position, then there could be an opportunity coming up that we're going to get to at the end of this video. But this bull pattern, we're still inside the bull. And you can see that, and this bull, you can draw it in a few different ways, but most of it stays within this one section of the bull. And moving on to the next one, we're going to get into more of what is happening today, right now. And when you look at weekly transparent gold holdings, now this is from Nick Laird of Gold Charts R Us. And what you see is this tremendous accumulation that happened right after the March crash in April, May, June, July, August. And with that accumulation came this tremendous rise in the price of gold. But then you see that it sort of, the accumulation petered out. There wasn't as much interest in the buying. In September, October, there was a little bit of buying. November, there was some selling, and the price leveled off and started to fall. And we started building this wedge pattern, or, they call it a wedge or a flag. And there's just been a little bit of selling. So the upper portion of this chart, the gold part, is the price. The blue line is the millions of ounces held in published repositories, mutual funds, and ETFs, everybody that reports. And you can see that that sort of leveled off. So there's no more buying pressure. There's not much selling pressure. it's sort of a 50-50 mix, enough buyers and sellers on both sides to where the holdings leveled off. And the price, because of this lack of interest, starts falling. You move on to the next chart, and that's the silver chart. And this is where we get into the Wall Street bets, people, and the silver short squeeze and all of that. Because what you see here is the accumulation back in April, May, June, July, and the price rise that happened from the March lows. The gray line on the top chart is the price, blue line is the amount of holdings, and you see as those holdings increase, the price explodes and goes from around $12 up to $28 here. I would imagine these are weekly prices because it almost hit 30, I believe. And then you see it chopping sideways. And then the silver short squeeze started from the Wall Street bets people, the Reddit crowd. And you see all of this accumulation on the lower half of the chart again. And one of the weeks here was, I think, the biggest accumulation in a single week ever. So you see 2 weeks of accumulation and then one explosion, and the price goes up with it. But then you see a week where there's selling out of it. And it was, they've got the weekly change here. So you're talking more than 25 million ounces. And then just a little bit of accumulation. Now, this chart is for last week. So we won't see what happened this week until next week. So what do you see in these, Jeff? Is there anything that you see between the gold holdings and the silver holdings?
Well, that's what I was going to point out, is that the gold holdings leveled off, but the silver holdings continued to rise pretty significantly there. And again, due to the Reddit Wall Street bets crowd. But still, the bottom line was the amount of holdings increased dramatically, whereas gold didn't.
Right. But what I also see is tremendous volatility in silver. You see the Reddit crowd accumulating in the first 3 weeks, and then their accumulation in the fourth week of the silver short squeeze was more than neutralized, more than offset by people that were taking profits and selling. And so even with the Reddit crowd coming in and buying, you had outflows in that week of more than 25 million ounces. The Reddit crowd, I believe, a lot of them are trading on margin trading accounts, and they're very highly leveraged sometimes. They trade options and things like that. And most of them buy in SLV. And this next chart shows that, the next two charts. This is transparent silver holdings, so it's the published repository. So it's the total amount of silver in all these different published repositories. And you can see the accumulation since mid last year in the COMEX vaults. And then the next chart, this chart is everything this century. The next chart is a close-up of just 1 year. And you see the Reddit crowd coming in at the end of January, and this big accumulation at the end of January in SLV, the light green area. Nothing was taken out of the COMEX. The other funds, everything that has a bump in it that's above SLV is because it's sitting on top. These are all sitting on top of each other. And so the change in holdings, the Reddit crowd bought only in SLV. And SLV, it's one of the things where what we've seen over the past couple of days with the announcements, the change in the prospectus, these exchange-traded funds seem to almost be set up as another way of manipulating the price of silver and gold. And the Reddit crowd was, I believe, sort of buying in to this manipulation, unwittingly. They think that this is taking it off of the exchanges. There's no change in the COMEX. Now, it did change the amount of the London exchange, and that is not listed in here. That's not part of the listings that I see in the legend that's on the left-hand side of this chart. But you can see the sudden explosion in SLV holdings, and the price moved with it. But somehow they were able, even with this explosion, if you look at the top of the chart, the total number of millions of ounces, that's an explosion that should have taken silver past its previous $30 high. And once it cleared that resistance, it probably would have run significantly up into the mid-30s, maybe even up to $50 once again. But the powers that be seem to be able to cap this and manipulate it and keep it from exceeding that area of strategic resistance. If it had gotten past that, they probably would have lost control. So the Reddit crowd did not push it far enough. They needed to take stuff off of the London Exchange, out of the COMEX bars, meaning you buy physical and you take it out of those vaults. You don't leave it in a vault where SLV can be shorted. All these people have margin accounts because they're looking for quick, fast gains. I'm a very patient guy. I've been playing this now. I'm coming up on 20 years. It's been very rewarding. I mean, I've had spectacular gains, but at the same time, it requires a lot of patience, especially to ride the silver roller coaster. And
what I see in this chart, Mike, is that silver holdings continue to accumulate. They spiked with the Reddit crowd, but the trend is clearly up. This is a 1-year chart, and investors continue to buy physical silver or representations of physical silver. But in the big picture, the trend is up. People are continuing to buy silver.
But all in derivative type accounts. Everything on this chart is a derivative of silver. They're not buying silver. If you have a margined account on SLV and you buy SLV in your margin trading account, margin enabled trading account, if you're allowed margin, buying of 2-to-1 or 5-to-1, which is very common. If you're 5-to-1, you're putting down $2 and buying $10 worth of silver. And it shows that you've got $10 worth of shares there. However, 8 of those shares were loaned to you by the broker, and the broker can borrow. Those are IOUs for shares. They're not shares. They're the broker's IOUs. Those are the shares that they can borrow at any moment because you don't own them. You've only put a down payment on them. They can borrow those shares and loan them to a short seller that now sells those same shares, those same ounces of silver to somebody else, and now 2 people own the same ounce. In other words, the price gains that should have happened from that second ounce being purchased were just neutralized. And so they're buying in to part of the price manipulation. If you can neutralize all that new cash flow that's coming in and not let it push up the price, that seems to be part of the object of this. So anybody with a margined trading account is versus buying it's 1,000-ounce bars that are on the exchanges. If you bought a futures contract and took delivery right away, or a short term, a near month futures contract, took delivery at expiration, whatever. If you buy a basket on SLV and take delivery, but it's easiest. It all comes from 1,000-ounce bars, and there's only so many of them out there. It's just easiest to buy physical silver in any form because all the other forms are made from the 1,000-ounce bars. So you just buy physical silver and put it in private storage, in a storage account, or take delivery of it at home. A private storage account that's insured in a vault that's not in a location where it's also a commodities exchange vault or a vault for SLV. So the next chart is gold, and I drew this. This is drawn just today, and on stock charts, they don't have the information for gold and silver that day. They only do it after the close. So this is yesterday's information, February 17th. And what you see is the moving averages are now up there. We've got something that's either called the kiss of death or the death cross, where the 50-day moving average, the green line, is touching the 200-day moving average, the blue line. Now, it could bounce off of it, very bullish. If it crosses through it, that could be a negative. Since this is 200 days of information, we won't know for a while. It's a very slow-moving indicator. But you've got the 50-day and the 200-day. Now, the 50-day could dip through this for a short period of time and then go back up, and that's very, very bullish if that happens. And then we have the 250-day, because that encapsulated, if you look at the intraday moves down in the March lows, we have the beginning of that bull market since March. It encapsulated all the intraday moves, the red line, the 250-day moving average. And then we've got the retracements, the blue horizontal bands. And you'll see that we have dropped back down to that 1770 area. It's possible that we could see a drop, but we're in this major trading range support that happened. I didn't even have to draw the trading range support because it's completely encapsulated with the 61.8% and the 50% retracements. And that 61.8 also has the previous peaks, which are support lines. So you've got some really significant support here. And we're right on it right now, which suggests that gold should go, has a good probability of going up. There is no like triple magnet down at the 61.8. If we go into a bear market and there's a cup and handle that we're forming, I think we might visit that 61.8, but I doubt it. Today is probably a good day for buying gold. If you look at the silver chart, we're still way above the 50-day, the 200-day, and the 250-day. Silver is so highly volatile that none of these moving averages encapsulated the big crash in March. And you see the trading range highlighted in the green box that I made, and there's the Fibonacci's. There is, other than the 250-day moving average, but that doesn't seem to have too much to do with silver's price. That's near the 50, and the 200-day moving average is right on the 38.2% retracement. But what this shows me is that I'm a big buyer of silver at 24. If we reach down to 24, I'm going to be buying. If we breach the $23, $22 area, then the real major support is at about 19. So, but there's also something called round number support. People just like round numbers. So I'm a buyer down at like 2050 and below. I would be backing up the truck, buying with both hands. I'm not a fan of theft in any form, but it's time to beg, borrow, or steal. If you see $19, sub $20 silver again, would be like the gift from God. And so I would be just backing up the truck and emptying all of my cash position and possibly some other positions at that point. And I am going to be making some purchases here because I'm going to lighten up on some other positions. But these are just some, this is just technical analysis, but I do think that the Reddit Wall Street Bets crowd, they're looking for quick gains. And they may have played into the hands of the big money, the big bullion banks and stuff, trying to do this squeeze, and they were almost successful at it. They came within, they 87% at one point of the silver in the London vaults was in the exchange-traded funds, the ETFs that they had. And so they only had 13% to go. If they had been able to clean that out, something would have broken. We would have had $50 silver. If they had taken all of the silver that they purchased in physical form, not in a derivative form, and all of these things, SLV, GLD, the commodities exchanges, futures, options, they're all derivatives. They're not gold and silver. If they had done that, we would be seeing $50 silver today. But they didn't. And so we have seen a divergence between the physical price and the spot price that is quoted, which is what the ETFs trade at. That spread, that premium, has exploded during the shortage of physical that is out there. And so anyway, that's the story. I do think that there's the potential. I know that, again, that people hate this when I say it. I'm sort of comfortable with my position. I've accumulated quite a bit over the past 19 years. So with all of that, if it goes up from here, I don't have to make any more purchases. If it goes down, I'm going to back up the truck and load up. But right now I'm going to continue. I've got some accumulation. I will be making some more purchases just because I want some different forms of silver. But I think there could be a giant opportunity coming up. And I think the Wall Street Bets crowd, unless they can get a whole bunch more buyers right now, they might be playing into the, one of the things about all of the big trading houses and the hedge funds and everything else, they've got level 2 trading platforms. When you've got like a Bloomberg and stuff, you can see all of the buys and sells and the limits and stop orders and everything else that's out there. You can see those and you can run the stops. You can see that, and people tend to do herding patterns. And so they'll have stops at round numbers. They'll have stops at sell stops at Fibonacci's. When you see clusters of stops, all they have to do is add a bunch of shorts, push the paper price down, and if it hits that stop, there's a cascade that happens. A whole bunch of stops get triggered, a whole bunch of sell orders happen, and then it hits the next one, and those blow, and it's like fuses blowing, and the price goes down. But you got to use that when it's going down. This is the reason that I don't. I caution people that don't have level 2 trading platforms on using margin and options and everything else. A few people are successful at this stuff, but not many. The professionals see all this stuff. They manipulate the market with it. And there was one period, it was many, many years ago, I think it was back maybe it was during 2008, that you could see where this game was run on everybody, where the big trading houses just piled on enough shorts to trigger this cascading grouping of stops and cause a huge plunge. And then they go long after selling short. They cover their shorts and they go long and they scoop it up on both ends. And the best thing to do is to sort of see, is there a setup where this could happen again? And I believe right now there is. And all you want to do is try and be on the same side that if the big boys if it looks like the big boys are going to win again. And to me, the big push when silver hit $30 back at the end of last month, when that failed, this changed from the Wall Street Bets crowd being in control to, when the volume of buys started to become exhausted, and the volume of sells started to exceed the volume of buys, like we saw in that 1 week where there was ounces that outflowed. At that point, the big boys are in control once again. And I do think that some of these Reddit Wall Street Bets crowd will probably start selling eventually, especially if they're leveraged. And if they bought on margin or if they've got options and they've got to cover. And so we may see this plunge back to like that 38.2% retracement, possibly back to those lows at $22, which is where the 250 day is rising toward. And so that's it. Any comments here at the end, Jeff? I'm sorry I talked so much. I dominated the conversation.
Well, this has been great, Mike. These are very insightful charts. So thank you for putting these all together. And I have to say, I have to recap what you said. Mike Maloney will back up the truck on silver and spend all his cash on silver if it falls to that $19, $20 area. So that's not
all
advice.
Of my cash and sell some other positions too to take advantage of this. And another thing that we may cover sometime in the future, which is more your specialty, is the mining stocks. If you look at GDX, GDXJ, HUI, these things compared to the price of what gold is doing and what silver is doing, the stocks typically lead the direction that things are going to go. And so that added to things like we just covered can give you a good clue. And the stocks is more your area than mine. So
yeah, we'll talk about that. One of my favorite subjects. The bottom line is gold stocks rise more than gold and they fall more than gold. So the timing can be important there. But Mike, this has been great. And just to let everyone know, Mike will be making some moves here fairly soon, and we will inform insiders when he does that. So Mike, we'll close this video out with a meme of the day that you can read. But just a reminder to everyone, if you've not read Mike's book, you can do that for free. It's still applicable today. So you can download it, the links below this video. So Mike, give us the meme of the day as we end our video.
Okay, this is the big boys that are doing the manipulation. Nothing to see here, folks. Move along. Thanks, Jeff. It's been great.
It's been great, Mike. Thanks, and we'll see you tomorrow.
Okay.